Welcome to TheoTrade. This is Don Kaufman. Here we are. It's April 14th, 2017. We are doing the weekend update here on Friday. Of course, this is an extended holiday weekend. Let's get right to it as there is a lot to talk about. Not only this past week in trade, but more appropriately, looking forward. Well, as we said, let's get to it here. First of all, the markets as a whole, specifically the SPX, did something very, very unexpected. And no, I know what you're thinking, that is sell-off, right? Oh, an unexpected sell-off. No, we actually cracked outside of the expected move at the last few minutes of trade on Thursday. And this, I'm telling you, is critically important. It's a turning point for the tone of the entire marketplace. And if you haven't really followed along TheoTrade for a period of time, I talk extensively about expected moves, and I'm going to elaborate upon that here momentarily. But again, the critical point being the market cracked outside of the expected move the last few minutes on Thursday. It's a display, and I'm telling you this right up front, it's a display that the efficiency of the marketplace is starting to break apart, and we are moving to substantially more volatile times. And again, this is the first time we've really cracked outside of an expected move. So let's explain a little bit in more detail here what it is that I'm emphasizing. First of all, we're going to take a look at the spiders. For those of you, the spiders, it's a happier, gentler product. You know, very often I talk about the SPX, which can be a little bit intimidating, but what I want to do to begin with is be forward looking. So if you take a look right here, right now, I'm actually taking you into an April 21st expiration. There's a full 7 days left. The expected move for next week is up to $3 and approximately 42 cents. Again, that includes a full 5 days of trade, $3.42. Now, for those of you that look at the SPX, that's the equivalency of just about, let's just round it to a $35 move in the SPX. And you take that immediately over to a chart and you're like, okay, a $35 move. Well, it doesn't tell you, like, let's just be clear about this. The expected move, it's a plus 35 or minus 35. You know, expected move has zero directional bias associated with it. At least the way the calculation is, there's zero directional bias. Now, a $35 expected move. The reason I just went forward looking is because now I want you to see how that compared to the previous week. So what I'm in right now, and I use this quite often in doing these kind of evening and weekend videos, this is think back. It's end of day data. It's just end of day snapshot data. And what I've done is I've taken us from today, which is April 14th, and I just backed up over here to the previous Sunday, which was April 9th. Now, this was a shortened trading week. It only had 4 days. So here's 4 days of trade. And again, we're looking at this as if we were looking at from last Sunday, right? And what's the expected move? Well, it's about $23.60. Now, the reason I'm mentioning this because next week, which is a full 5 days, is expecting almost a $35 move. You can see, okay, quite distinctly the change in tone of volatility. So this previous week, was a $23 expected move. And frankly, people, that was even elevated in recent weeks. I'll go back even the previous week before that, okay? And we'll go back and we'll look at what does a normal 5-day period look like? Well, lately we've been seeing $23 expected moves for 5 trading days. All right, that's for 5 trading days, $23. And if you go back the week before that, and the week before that, and the week before that, people, I can go all day long. There's even an FOMC announcement in here where, you know, here's a 5-day period. Again, this was elevated because the FOMC announcement. This is some of the highest volatility we've seen lately, was about $35, $36. And that is exactly what we're facing this next week. Now, the point of going back and, you know, this little exercise over here is to recognize in any recent week, we have not cracked outside of the expected move. In fact, in most recent weeks, we've gone right to the edge. For example, Okay, I moved this back to April 9th and it was a $23 expected move. So let's do some just quick and dirty math over here. Now we all recognize the market sold off this week. So here we are at 23.55, right? Okay, 23.55.54. Let's split hairs, let's be specific. And I want you to subtract, okay, subtract $23 and roughly 60 cents equals, well, the bottom of the SPX should have remained right at about 23.32. We're just rounding it. 23.32 was the bottom of the SPX. The SPX in the last moments of trade over there, it actually cracked through it. And again, trade became fierce. I mean, absolutely fierce in that last few moments. You can see the markets bouncing in and around, all right, this 23.32 level as they're trying to hang on to the expected move. And it's not just like the expected move and everybody looks at it. It's not just about a self-fulfilling prophecy. The option markets themselves, okay, are priced off of those expected moves, meaning that it's the option pricing itself that determines the expected move. And what happens is that when the market moves to the edge of what's expected, okay, volume will explode in the S&P futures as traders are trying to mitigate their risks. And you can see specifically inside of the S&P futures, okay, the S&P futures closed right here at about what? 23.27. If you look specifically at the S&P futures, and the S&P futures, again, this is a little confusing. This product is used to hedge the SPX. And you can see volume is just on fire the second we came through the expected move. And you're seeing volume bars exceeding, 15, 20,000 contracts. Obviously, at the cash close, also significant. But even in the after-hour trade inside of the S&P futures, they're still firing 10, 12,000 contracts out there. So the expected move, we cracked outside of it ever so slightly. And again, the most important point of this being, it's starting to show that, again, fear and that inefficiency is gripping hold. And in addition to it, so this is the first time, again, we've really cracked outside an expected move. Since when? Okay, when was the last time we really cracked outside of an expected move? And I can give you specifics on it. Just go back up here to a chart. Okay, this move after the election, let's just be clear about it. This move, totally priced in. That move was priced in. The volatility was already elevated right here. Okay, that move, that was a 3 deviation move, 3 sigma move, was right there. And that was the week of December 5th. This totally normal up here. Okay, also very, very normal moves. This is the first time that we've also cracked the expected move to the downside. Even if it was a few dollars, it matters. Okay, again, it's a complete change of tone for the markets. In addition to it, like, you don't just look at like one thing, you're like, that's it, volatility is upon us. Okay, in addition to it, if you looked at the advanced decline line, now this is specific to the S&P 100. The S&P 100, right, here it is. You had almost full-blown correlation. That basically means there's 90 decliners out there, which is much more prototypical of a high volatility situation. When markets are really rocking and there's capitulation and everybody's flipping out a little bit, you typically see approximately between 93 to 95 decliners. Okay, so there's kind of what they call between 93% and 95% correlation in a marketplace. Now, granted, this is even including there's earnings going on, and earnings kind of kicked off really heavily, on Thursday. A lot of the bank stocks had earnings. There's a bunch of earnings coming up. I mean, just a slew of earnings coming up next week. It's neither here nor there. Okay, if volatility grips hold, you won't even remember about the earnings. You're like, but what about Netflix? What about it? What about Bank of America? Okay, it's going to have earnings. Doesn't matter. All right. I mean, the earnings announcements are very much secondary to the volatility of the marketplace. So we see full-blown kind of correlation coming out of the woodwork. We're seeing ourselves crack through an expected move. Obviously, the volatility products are lit up. But again, and I mentioned this on Wednesday evening, the VVIX, right, is screaming right now. Now, I want to be crystal clear because I got a lot of emails about this the other day. Once the VVIX hits 115, okay, this is it. It could go down from here. That does not mean risk abates. I want to be, again, crystal clear about this because so many questions came in. When the VVIX spikes, okay, it basically means the trade, they're buying volatility in the volatility index itself. The VVIX is a measurement, okay, of intensity of trade, if you will, inside of the VIX product itself. And people, it's intense out there. But after the VVIX peaks, it could contract back, but it doesn't mean that the risk has necessarily abated. And that's a critical point to be made over here, because if you see the VVIX drop next week, don't get off your game. And let me show you exactly why. If you're looking back, okay, and this is a 3-year chart, and you look back, here's a big spike in the VVIX. People got all the way to 130 and then dove off, okay? And if you remember this time frame correctly, and a lot of people, you know, they're not like human markets. I am. I mean, that's what I do every day. I'm watching markets constantly. But I want to show you, the VVIX had already come back down. And, you know, this, when I say this area right here happens to be, okay, and you can see the date right here. It's right around the end of January, the beginning of February of 2016. So you're like, okay, where are you going with this? Again, look, this happens to be right here, all right, January 29th of 2016. Now go look at the SPX in the exact same time frame, and I want you to see what the SPX was doing in the exact same time frame. It was getting absolutely pummeled. Now the VVIX was dropping at that point. The marketplace saw the risk before the market really started to tank. Because if you're looking back here into December of 2015, and again, you know, I don't do a lot of like technicals and I don't do a lot of regression, you know, but it's important to know that a product like the VVIX, it gets lit up before the market typically gets hammered. And in this case, well before. So keep it in mind, because if VVIX just backs off, you'd be like, oh, it's okay. Everybody put away the weapons and ammo. We're going to be just fine. Yeah, well, you might not be, because there's a reason that everybody's buying volatility. And once they've bought volatility, that's it. At that point, you know, kind of all over but the crying. But it's incredibly rare to see the VVIX light up like this and nothing occur in broader markets. Speaking of broader markets over there, okay, let's talk about the financials for a moment. Now, again, I'm not much of a, you know, the market technician over here, but ladies and gentlemen, we're in a little bit of a downtrend. If you are into technicals and so forth, I love drawing patterns, you know. This is, you know, one of these. It's what I call, ooh, it's my ghost pattern, all right? Apparently, I made that ghost a Cyclops as well. Nevertheless, the only reason I'm bringing up the XLF, you're like, well, it hasn't done anything. Yeah, it did break through the 23 level. And I think that that's pretty important, okay? So the XLF is actually bottom of the range, hanging on by a thread over here. In addition to it, and again, I'm not going to just stop at the XLF. You have to have a confluence of products. You got to look at the Russell. The Russell is at the bottom end of the range, but hasn't cracked through. The Russell somewhere down here, okay, and when I say down here, right around the 1330 range, if it gets to that neighborhood, okay, that is the first and most, I would say, dire warning of the broader markets out there. So again, everywhere we're seeing some sell side activity. However, the Nasdaq, it's still faring extremely well. And I've been reiterating this for the past few weeks. If there's a product, okay, that you'd want to short, it's going to be the Nasdaq. Again, if you look at the S&Ps, and here's, you know, the S&P futures, and again, if you're a trend trader, I don't know, what's the trend? It's down. I mean, the most recent trend is down if you want to draw, a channel around it. But if you looked at a longer term chart, again, that's where you can convince yourself of anything over here. But in short duration, we've got a little bit of a downtrend. And if you look at stuff like year to date, we're starting to get into some pretty critical territories here. Year to date, okay, pull up like a daily chart. And this is year to date, show prices percentage. The S&Ps, which were up again, 6-7% on the year, are now basically up 3%. Again, why am I pulling up the SPX? Because I want you to compare it now to the NDX, which is the Nasdaq. And the Nasdaq is still up 9% year to date. How does that compare to the Russell? The Russell is now down 1.5% year to date. That's why I'm telling you right now, again, if there's a product that you're going to want to be short, it happens to be none other than the Nasdaq. It's the outperformer. And for those of you, if you're into the idea of pairs trading, you can go out there and buy the S&Ps and sell the Nasdaq. Frankly, I'd be a little nervous on the Russell. That happens to be one of my largest short positions right now, is still inside of the Russell. And has it started to pay off? Well, on a year-to-date basis, yes. However, the Russell hasn't really cracked and broken yet. And when it does, this thing could be fast, it could be furious. It's extremely important at this point. And again, I like to show evidence of really the market and kind of the volatility starting to pick up, and obviously some of the internals deteriorating on a number of different fronts out there. But it's also important to note, for those of you that are a bit more experienced and you've traded through some volatility in the past, do not get too punchy and too happy-go-lucky about selling options premium just yet, okay? We are still in an incredibly low volatility percentile. Here is the Russell. Now, the Russell carries with it substantially more volatility, but the Russell's still sitting around 20% implied volatility. For those of you unaware, if you look at what's termed an IV percentile, what that basically does is, here's implied volatility, for example, for a period of a year. The percentile being at 50% says we're right smack in the middle, okay, range of where Russell volatility has been over the last, let's say, 52 weeks. So the Russell's IV percentile is up to 49%. It's starting to increase. However, if you look at products like the SPX, okay, cruise down to the SPX, it's only at the 36th percentile, which means, come on, people, we're not even catching our stride yet. And I think people are going to jump out there and they're going to sell premium into the onslaught of volatility. Be restrained, okay? Your opportunities will come, but it's been so many years since we've seen any degree of volatility, okay? One of the things that really resonates with me right now is that so many professional traders I know, people, they're looking for the down move. They see the same things I do. The VVIX is lit and the XLF is coming off, and even the XLE is weak over here and the Russell is ready to crack, okay? And we came outside the expected move and yada yada, and they give you 20 different reasons. And we had full-blown correlation, on the S&P 100. They're all looking for the down move. And I'm telling you, in the midst of extreme volatility, the most wild move is actually going to be the bounces. That's how we're going to know that we're in a more volatile situation. But what it appears we're entering into here is we have gone through an incredible amount of efficiency, okay, and a market that has done nothing but rally, literally, since 2009, okay? You have to, first of all, question to yourself, is this going to be it? Are we going to really be in store for some volatility? And if the answer is yes, and you do believe that we're going to be in store for some volatility, I think you need to be aware that this is going to be a much longer duration volatility than traders are anticipating. This isn't going to be a flash in the pan. This is a marketplace, okay, that has traded straight up since March of 2009, okay? Little tidbits of volatility here and there along the way, but I cannot overemphasize, keep some powder dry, allocate very, very carefully initially, because what appears to be just some mild volatility, you have to start to put this in context. Have we been seeing 3% moves in the S&P? No, not even close. Okay, we haven't felt the brunt of what markets are capable of in years. I mean, sure, you can go and point out, oh, there was one day in August of 2015. This is nothing. It's one-day type events. Okay, we've seen some explosions to the upside, which have been phenomenal, but we haven't seen true downside activity. And this generation of traders right here, right now, traders that have really only since actively trading, maybe since 2009, they haven't experienced turmoil yet. Think about it this weekend as we start to forge forward and possibly into a substantially more volatile situation. Thanks everybody for joining us here for the weekend update. Enjoy TheoTrade all throughout the course of this next week. Have a great weekend. Bye-bye.